this video, we'll be talking about TIPS development and also the Fed's next move. These are the topics we'll be going over today. Again, none of these are investment advice, just my personal opinion. Please do your own research. So first off, let's take a look at the bond market. It's continuing to hemorrhage. The long end continue to rally, and because no one wants to buy these long end bonds because of inflation expectation continue to go higher. And so that's why we see the long end continue to rally. The short end continue to have pressure lower. So the yield curve continues to steepen as there's more people trying to, like the banks, majoritarily, they don't want to lend out money. So what happens is they're buying more on the short end and selling the long end instead of lending it out to people because inflation expectation is increasing, so they don't want to make as much loans and lose money on the repayment being inflated. Now let's talk about TIPS. What is TIPS? So TIPS is the Treasury inflation protected security. It's just another U.S. Treasury. However, it has its coupon and face value gets adjusted to inflation, through a factor. Obviously, their calculation of inflation, which is CPI. As you can see, as of March 4th, the yield on the TIPS 5-year is negative 1.66 because people want to buy it, so that's why the yield continues to go lower, as you can see right here. And so the characteristics of it, it's inflation protected, has limited supply because for the US government, there's no way to pay off its debt through honest taxation, because then the politicians won't be favored, and therefore the way they've chosen to pay off their debt and deleverage is by inflating it away. Well, if you issue a regular treasury, fixed rate, then you can inflate that away. But TIPS, if it's inflation protected, where its coupon and face value gets adjusted to inflation, then you're not paying it off with inflation. So therefore, if you actually look at the supply, TIPS actually has limited supply. You can't increase more issuance of TIPS, or else you defeat the purpose of issuing treasury and try to inflate it away. You're not paying off any of the debt. And finally, it's backed by US government. So these characteristics, to me, makes it sound better than Bitcoin, because you have your inflation, like supposedly inflation proof, like Bitcoin is. My opinion, no, not really, because it has no value anyways. But some can argue. So it's inflation protected. It has limited supply because the US government has no intention of increasing the issuance of TIPS. And what's better is it's backed by the US government. Obviously, you have the part where it's not private, it's no third-party risk on, but otherwise, it sounds pretty good. If you are into crypto, maybe consider TIPS instead. Now let's talk about the Fed's up dilemma. So they have to keep the long end yields lower because it lowers the cost of US government borrowing, and it avoids the bond market imploding because a lot of the US denominated debt are pegged to US treasuries. But I have discussed this before, where they can't print money without making inflation expectation higher. And inflation, when it goes through velocity and it eventually gets to the market. And so what happens is, to US Treasury, the short end continues to decrease, so they have to sell more of it because they hold a bunch of US Treasuries. The long end keeps rising, they have to buy more of it, so we should see Fed portfolio of securities continue to move average maturity to the longer end, meaning they're more exposed to a hike of to inflation. And finally, tips, the yields keep going negative, so they can't buy any, because by buying more tips, it pushes the yields even lower, so they can't buy any tips. So if they have any, they should sell. And finally, I think YCC is just on the way. We'll see in the next Fed meeting, I think in 2 weeks. And really, they're waiting for more treasuries to be issued, or Powell just has to, open the floodgate and start buying up all these long end bonds. So far, he's just been trying to talk through different occasions, trying to say inflation is not a concern, and he expects inflation to, be low, because here's the thing: they want inflation, and that's the only way they can, deleverage. The last thing they want to do is for the public to realize that inflation is going to be higher than expected. I mean, it's already here if people just take a look. And that's why he has to keep on the lie that there's no inflation. If there's any, it's going to be mild. It's not going to get out of control, in order to continue his policy of continuously printing. So I know I've said short term would be bullish in a few videos back, and then I think one of the more recent video I said I had no idea, because I felt like I was getting it wrong, because the rally I was expecting didn't happen. But I think it just hit a short consolidation phase, and I think now it's back on the rally. So we'll see if I get it right this time. So I think I was just early. So US dollar DXY is back at 92. Yellen has mentioned, the Treasury Secretary has mentioned multiple occasions where she doesn't see a weaker dollar. And the reason why the US government needs a strong dollar, at least like a steady dollar, meaning it doesn't depreciate, is their only way to deleverage is inflation. Again, going back to the previous slide, where they can't pay off their debt honestly with taxes or cut spending, because that's not not good politics, and you're not going to get voted in by doing that. And so in order to maintain control, the only way is to sneak it through inflation to deleverage. So there's more stimulus bill on the way. I don't think this 1.9 trillion will be the last one. I think there's going to be more. And there's no demand. There's already no demand for long-term treasuries. So if they print more, if they issue more, it's just going to push the yield higher, because there's already no demand for it. And they can't issue tips. So I think that maybe they'll try to issue more short end US Treasury to try to help out with the yield curve as well, and not as much long term. And finally, US is a consumer economy. Trade deficit continues to increase. So, but people aren't working. So how is a consumer economy going to function? Is that's why UBI, more unemployment benefits, like all more quote free money has to come out in order to keep the whole system going. But if you're having inflation and your dollar is decreasing in value, then they can't buy as much, then it defeats the purpose. So that's why a strong dollar is needed. Well, what is the solution? Oil is key. That's why I think oil will, it will continue to be strong. Obviously, OPEC and Russia wants higher oil prices anyways, and I think US will make sure to keep a check on any members that in the Middle East that are trying to cheat the system by increasing production, because US oil is pegged to the dollar, and therefore US has to make sure the higher oil prices are, the more US dollars you need to buy oil. And there's also a chance that more people are keeping more dollars, so they go buy short end US Treasuries to try to earn some interest before having to use the dollar to buy oil. So that also helps on the treasury end, and so therefore higher oil prices definitely key, and also the higher yield also help. When US has higher yields, then there's more investors willing to put money into US Treasuries because yield a better return. But I think that won't be as big of a factor because they also have to keep yields lower to try to not increase the borrowing cost. So oil definitely key. So let's talk about China's approach. So what has China been doing? So in the previous financial crises, US remained strong by first, they drop rates, print a lot of money, flood other markets with US dollars, and then inflate their bubbles in other countries. And then what they do is they shrink the liquidity, and so they pull US dollar away from now inflated markets in other countries, popping their bubble first, and then maintaining US dollar market strength in comparison to other markets. So other markets investors will have to come back and they see the outperformance in US markets, so they come back into US market instead of and other economies just get decimated. China has saw through that scheme and they don't want to participate anymore. So that's why the Bank of China hasn't been printing as much. They're focusing on deleveraging. So that's why you don't see rates get cut as much. You don't see balance sheet expand as much. And a lot of officials have said multiple times that they don't want to see a bubble in real estate, stock market, such. And what they have also been doing is they buy up commodities. So they have done records amount of agriculture goods buying, and also they try to buy up a lot of oil, because what happens is the only way for China to be controlled by foreign entities is there's a lot of people in China, so they eat a lot, and they're also one of the biggest energy users. So therefore, by securing these two, or at least increase the storage of it, they can have better control of their economy. And what this would lead to is a stronger RMB and a stronger economy for the long term. And what this will do to other countries is, because of a monetary tightening of China's monetary policy, the stronger RMB and higher yields would increase the cost, because of foreign exchange, cost of China exports. So therefore that entails a higher inflation pressure in other countries that imports from China. Now let's talk about the stock market update for US market. As we can see, so this is a diagram of NASDAQ as of March 4th, I believe, and we can see that there's a false breakout right here to the upside, and it's come back down. Now we're at the neckline, and we broke through that on Thursday, but we were able to climb back up to 12,900. So that's a key level where the shorts want to break below that, and the longs want to break above it. So that's a key level. If that breaks through, we could see, low to like 12,100 or even lower. So that's a key level to, hold. And for the Dow and S&P 500, they're also approaching their neckline. So they also had a false breakup, and they're approaching their neckline. So again, they have to hold it. And Powell has been going around saying, hey, inflation's not a concern, and if and inflation expectation is only rising because a good economy is happening. Well, obviously, with continuously records amount of weekly unemployment, first-time filing of unemployment, we're not in a good economy. comparing to what we had prior to the pandemic. And so it is crazy to think that inflation expectation is only happening because of economy recovery. So that's a lie. It's just inflation's happening because, money printing. And the risk, I think, is still to the downside until the Fed increase liquidity again, either before or after the next stimulus bill, but they have to buy up the yields. So once the yields along end are capped, meaning they now start to decrease, then I think the pressure on the stock market will, fade away, or at least subside. My bet is, we'll continue to see. I think Powell will come in sooner or later, and I don't know if the stock market will make a new high. I don't think that would be a case. I think it will just continue to consolidate. If it gets too hot, Fed will pull liquidity. If it gets too down, then he'll add liquidity. I wouldn't be investing in it, but I think short term, very short term, like a day or two day trading, I think this has a nice shorting potential. So finally, let's go over commodities update. Oil, it's $1, like Thursday and Friday, along with the OPEC Plus meeting. It's now $1 away from a 2 years high. $60 consolidation phase lasted much shorter than I expected. This again because of the OPEC Plus, they agreed to continue supply production cuts. So they're not ramping up even if Texas is not, the oil rigs aren't working because too cold. And even if the oil price continue to increase, they're not ramping up productions yet. And my forecast for the year remains at least $80, and I think we could see $100 for the year. And all-time high of 140, most likely not this year, next year perhaps, but by 2020 for sure. I think we will see an all-time high in oil. Precious metals, sentiment is very bad. Like no one is willing to buy. No one's confident because gold and silver, more so on gold, is seen as a inflation hedge. But as inflation expectations increasing, the metals are not performing. So a lot of people aren't being confident about it. In terms of the physical, the retail shortage continues. Just waiting for the impact on industrial, and that hasn't been impacted as much just yet. And the peak of nominal long-term yields would signal the bottom in both precious metals and also some way of the stock market correction. And I think we are within days, and longest would be weeks away from such bottom. So I think the metal and the miners, right, like at these levels are such great bargains, and I have been adding to my positions. And again, I think gold will outperform in the short run, especially when the rally begins, but eventually silver will catch up and outperform. So again, my strategy is buy the gold miners now, ride the wave up, and on the way sell some to buy silver miners to continue.